What are economic cycles? Why are they important for investors to understand? Whatever you're investing in, whether that be crypto, stocks, bonds, or anything really. Because essentially no one invests to lose money, but there can be external factors out of your control that can increase or decrease your returns. So it's important to understand where in the economic or business cycle you are, so you can make informed financial decisions based on that. So let's jump straight in and look a bit more at economic cycles. So what is an economic cycle? Well, an economic cycle is the fluctuations of the economy between periods of expansion or growth and contraction or recession. Many factors such as gross domestic product or GDP, interest rates, total employment and consumer spending can help to determine the current stage of the economic cycle. And an economic cycle is basically the overall state of the economy as it goes through 4 stages in a cyclical pattern: expansion or growth, the peak or the highest point in the economic cycle, contraction, labelled as recession here, which is obviously the downward movement, and the trough, which is the bottom point in the cycle. Please note that from an investment point of view, unless you're great at selling at the peaks and buying at the troughs, which is ridiculously difficult to time, the peak is actually not the best stage of the cycle. It's basically the beginning of a crisis for you, because it's only one way from there, and that's down. And the trough is where the recovery starts, so it's only up from there. But many investors don't think of it like that, and they can get caught up with the hype and the emotion of investing. So for example, people are still buying at the peak, so end up losing money when the price contracts. And generally speaking, you can see the peaks and troughs when you go back in history. Here, looking at the percentage change of real GDP in the US, that goes all the way back to 1947. Or here, you can see the same thing for Canada, going all the way back to 1961. And here, for Japan, that only goes back to 1994. So, as we've seen, economic or business cycles are normal. They take place over a period of time and are part of the markets we can invest into. But how can you spot where in the economic cycle we are? And you'll often find economists disagreeing about where we are in the cycle, or they'll essentially be looking at different metrics. So you can't only rely on one individual or on them specifically. But finding those who you trust and following them is a good starting point. And as I mentioned earlier, it's almost impossible to determine the precise timing in the cycle, for example, the tops and the bottoms. But there are some general indicators we can use. There are a lot, so I'm only including a few here, as it can be quite overwhelming. I'll go into more detail later, essentially after covering these general metrics to begin with. So we can look at the tops and the bottoms of the market, we can look at euphoria and market sentiment, and we can see the turbulences that affect the economy. But let's start off by looking at interest rates and inflation, as they've obviously been quite prevalent recently. And you can see in the graph here, interest rates from 1954 to the time of recording this video, and the recessions or economic crisis being the grey bars going down. So we can see that interest rates typically decline during recessions. They're on the way down in the graph, for example, as loan demand slows, bond prices rise, and the central bank eases monetary policy. And interest rates often go down before a recession hits, if you look back in history. So this is good to use to show us where we might be on the roller coaster journey of economic cycles. However, this is just a guide, and it's not always the case. For example, if some people are not playing by economic rules, this will distort it. And you'll see that if you watch the film The Big Short, for example. And we can look at the Fed and central banks as well, and how they play a part. And if we now compare interest rates with inflation, if inflation goes up, you must raise interest rates for inflation to come back down. As we know, the large increase in inflation we've experienced led to the increase in interest rates we now have today, thereby proving this. So we can generally speaking see where we are in an economic cycle by looking at these two metrics. But we can actually go one step further by looking at 2 specific indicators. Firstly, time. So which metric precedes the peak or the bottom or comes before it, which one coincides with it, and which ones are delayed. And secondly, we can look at the type of activity, so production, price, the trust, expectations, or monetary policy. So let's start off by looking at the means of production, so machinery, cranes, trucks, etc., and long-lasting goods, so consumer products like fridges and ovens and things like that. Because we can see that when things are good, companies and consumers often upgrade their means of production or long-lasting goods. These indicators often follow the GDP and slightly precede the expansion or the contraction of the economy. So in the graph here, you'll see that if we look at the 2008 financial crisis, for example, industrial production of durable consumer goods decreased before the crisis started, and that generally happens every time if you look back to the 70s and the 80s, for example. We can also look at vehicle sales, so cars, motorbikes, etc. And like above, they often follow the economic cycle and slightly precede the expansion or contraction of the economy. And it's the same, generally speaking, for consumer trust or sentiment. And the final one I'd like to share with you is construction, because it's often a good indicator that precedes expansions and contractions, and it can be quite volatile, which is useful to identify essentially. So you can check the stock market for large construction companies, e.g. this one in the US, as I've done here on investing.com, and you'll see that pictured on the screen. For example, from April 2019, Fluor's share price drops, which is well before the outbreak of COVID and ensuing financial crisis. Other indicators you can look at are bank credit balances, so how much banks keep versus how much they give out. Household debt, so the stronger the economy, the more debt households will have. So what could you invest in during different periods of economic cycles? And this isn't financial advice, but when interest rates are high and the economy is struggling, most economists will normally advise you to get out of holding assets that will generally decline. And you could buy treasury bonds, for example, as rates will generally be higher. And as you can see in the image here, some sectors perform better at different stages of the economic cycle. So as I think you can see here, it's very complex and there are a lot of factors at play when it comes to looking at economic cycles and where we're at, including how much liquidity is in the financial system and is created or printed by central banks. Because this increases inflation further, it reduces your purchasing power, and it means interest rates will eventually have to rise, all of which affect the metrics that we've seen in this video. But this has hopefully given you an insight and an introduction into economic cycles. I'd love to know what you think in the comments below, and please do like this video and subscribe to the channel if you haven't already, so you don't miss any future videos. And have a great day.